Welcome everyone to another episode of the Exploring Mining podcast. Today I'm excited to speak with Philippe Gijsels, Chief Strategist Officer at BNP Paribas Fortis. We talk about the book he co-authored, The New World Economy and 5 Trends that I highly recommend is worth a read if you want to be ahead for 2025. In this episode, we talk about commodity supercycles, favorite metals, other inflation hedges, and of course, Trump. As a reminder to investors, please read all disclosures and disclaimers at the end of the podcast. Philip, thanks so much for joining us on the show today. For listeners that might not know your story and your background, do you want to just give us a brief history of how you have worked in the markets?
Well, I started out looking at markets when I was 12 years old. My father worked for a competing bank in Belgium, and I started to read very fast about stock markets, about commodities, and about interest rates and so on. And after a while, I understood that things went up and down, and that you could actually make money out of it. So that was my start. And then I made all the possible mistakes that one could make. I started to buy things that were extremely low because I thought they could not go any lower. And of course, they went bankrupt. And then I started to buy very cheap stocks because with low PEs, price earnings multiples, because I thought, they will go up as well. But that was not a good idea either. And then I started to reading the books about with Jim O'Neill and so on. And I gradually started to learn how you look at markets. And after that, I honestly had a little bit of what you would call probably a boring career, because I started out with General de Bank, what was the biggest bank in Belgium, which became Fortis, which got into trouble during the financial crisis, was bought by BNP Paribas after the crisis of 2008, 2009. So to cut a long story short, I'm already 27 years the same bank and all kinds of strategy functions, analyst functions, and now responsible for the strategy and for the specialist teams for BNP Paribas Fortis. But a lot of Anglo-Saxon people would say that after 27 years, you're part of the furniture, but I'm okay with that.
Well, I feel like, all of us that have been in the markets for a long time, it's like a cult that you can't quit, right?
Something like that, yeah.
So let's talk about your new book that you have out, The New World Economy in 5 Trends. It's a wealth of information, fantastic. I personally love the tend to remember and tend to invest, because I feel like when you're learning so much information, it's great to have that synopsis at the end.
It's basically just my first book. And you start writing and you look at a blank page, and then that's at the beginning a bit scary. I did it together with my co-author Koen Deleuze, and he always jokes, I worked 3 years on it, which is true. And then he says, you worked also 3 months on it, which is also true. But because I had a lot of material for the last 20, 25 years, I could fairly easily write it. My son back then was studying in Singapore, so I had a lot of time during that summer, and I worked day and night on it. And it became eventually the book I really wanted to write, because it was going to be a book about economics and about, which it is in a way, I talk about inflation and the new world that we're going to have, because the main thesis is that with the COVID pandemic, a lot of trends have become stronger, like aging, like multi-globalization, as we call it, which is less globalization, debt, and then innovation and all these things. And most of these trends are really inflationary. So we believe that we're in an environment where inflation and interest rates and commodity prices will be structurally higher for the next 20, 30 years. And we're no longer in the world that started in 82 until COVID. We believe that we're back in the world of the 60s and the 70s, with unfortunately more conflict, with bigger governments, with big debts, with less globalization, with aging population. That's something a little bit different than the 60s and the 70s. But all these trends are wildly inflationary, so this is a totally different environment. So that's the main conclusion thesis of the book. But it's also a book about books, because we mention about 100 to 150 different books. And they always say when you steal from one person, you can go to jail. When you steal from a lot of people, it's called research. So we did a lot of research in our book, basically. And yeah, it's also a book. There's a lot of stories in there. It's about hunting the mammoth. There's a little bit of science fiction things that play out in the next 20 years. And there are also interviews with dead economists and that kind of stuff. So it's an economics book, but there's also a book about stories and about all kinds of things I like. So I'm very happy with it, and I'm also very happy that it was well received. We already sold, I think, 15,000 copies at the moment, and it was also elected to the summer reading list of the Financial Times over the summer. So as you can hear, a bit proud about it.
Well, you should be proud with those accolades. So the one thing that I kind of wanted to dive deeper into is the one chapter is the interest rate cycle is more important than the economic cycle. Can you just give listeners, because this is like the 60s and 70s, almost like a repeat, when they say history doesn't repeat, but it rhymes. So there are some different variances, obviously, but for these younger investors that are joining into the market that have no freaking clue what happened in the 70s, let's just talk a little bit about why you think that's so important.
Well, first, there are two things to that. Maybe start with the first part of your question. Indeed, the interest rate cycle is more important than the economic cycle. And then I talk mostly about stock markets because if that's just not an opinion, that's just an observation. If you look at the last 30, 40 years, basically since the beginning of the 80s, if you would have bought each and every time that the economy was doing fantastically well, and sold each and every time you went into a recession, because that would be following the economic cycle, each and every time you would have lost money. Because when the economy goes too strongly, when you have a big expansion, you get an overheating, and then typically interest rates go up. And in our world, interest rates are like gravity. When interest rates are low or even negative at certain moments in time, there's no gravity or very low gravity, and everything can fly. But when interest rates go up, all kinds of assets, also commodities, unfortunately, even gold. Gold has been suffering a little bit the last couple of weeks because the dollar is so strong, and interest rates are going up. It becomes more difficult to make headway, and that's what we saw. And then the other way around, you would say in a recession that's extremely bad for equities, because then typically you see profits going down and so on. But of course, when we have a recession, central banks start to cut interest rates in the short end, long end comes down as well, and typically that supports markets. So markets you have way better an economy that's not doing so fantastically well, but interest rates that behave or come down, then an economy that goes up is very strong, and then interest rates that go up. So that's not really an opinion even, that's just an observation of the last 30 to 40 years. Now, where you were alluding to, I think, was that indeed young people have never seen interest rates that were higher than 4%. And they have most of the time since 82 onwards, we had interest rates that were at 15 or 16%. Inflation was sky high. Volcker became president of the Federal Reserve at the end of the 70s and beginning of the 80s. He broke the back of inflation, and all that time since 82, okay, sometimes it went up a little bit, but it was like a staircase that you went down. You went down a lot, up a bit, down a lot, up a bit, until interest rates were zero or even negative at certain moments in time. And we think, and that's one of the main ideas of the book, that we have entered the period of the 60s and the 70s, and that was the opposite. You were running up the stairs. You went up a lot, down a bit, up a lot, down a bit. And I'm afraid with and that are the different chapters in the book, with all the elements that are at play, that you will be in an environment where inflation will be higher and interest rates will be higher. And that has massive repercussions for companies. Because to companies, we say you should hedge your interest rate exposure when you have an investment project coming on in 3 or 4 years' time. Make sure that you lock in the interest rates at what are still reasonably low levels. Same for inflation. If you can hedge your inflation around 2%, well, there is a big chance that inflation will be way higher in years to come. Same for commodities. Everybody hires AI people, and I can understand that. But when you're a company that uses commodities, I would hire somebody who knows the commodity markets a little bit, because I think that people clearly underestimate how high commodity prices could go if this bull market gets really going. So in short, this is a totally different environment for lenders, for companies, and also for individuals, for investors. Because what we always say, in a world where inflation is high, and it should not be 8 or 9%, but even when inflation is going to be between 2 and 4% for the next couple of years instead of between 0 and 2, there's a massively different environment. Because when you have 4% interest rates 10 years in a row, well, that cuts away about 50% of your purchasing power. And in that environment, you do not want to hold cash. You want to hold real assets. You want to hold real estate. You want to hold commodities. You want to hold equities. You want to own wine, old timers, art, gold, silver, whatever. Everything that's tangible. And that's a totally different environment. And you're absolutely correct. I think young people buy Bitcoin, and up until now, they're absolutely right, of course, but it also goes up. But a lot of people, and also the professionals that are in the market, have not seen an environment where interest rates go up, and that's something to think about.
We've seen, in the last couple of years that the 60-40 traditional portfolio has just not worked as well as it used to. And so I feel like most people are trying to transition or figure out where to go. Can you talk a little bit more about these are value stocks that basically have been undervalued, the whole commodity section, oil and gas. So can you talk a little bit about investing in the commodity and then the super cycle that you think we're coming into?
Absolutely. And of course, everybody knows we have the climate transition, and it can be bad, but we should be a little bit pragmatic about it, because all the chapters are interlinked. So if you kill your economy, then the fourth turning will set in even more. Extreme parties getting to power, and so on and so forth. So we probably should do this transition, but we should do it in an intelligent way. And I think we should have the mining sector on board with that. And if you transition from a world from oil and gas to a world of electricity, well, then you will need a lot of metals, a lot of battery metals. You will need copper and lithium and cobalt and nickel and what have you. I'm not even talking about uranium, because I think there is a uranium renaissance going on as well. And the fact that Bill Gates is starting 3 Mile Island in the United States, which was a trauma, which is our Chernobyl, or which is our Fukushima in Japan, for example. That's some big news. And yeah, if you look at the demand figures, so you can draw a chart from, it's also in the book, by the way, from Bloomberg consensus, how much demand there will be from 2025 until 2050 for all these metals. Well, there is a wall of demand coming up, and there is just not enough supply, because you have the problems with the permitting, the problems with the financing as well, because almost the entire mining industry and the oil industry to a certain extent as well, if you make abstraction of the shale oil, where of course some additional capacity has been added under the Biden administration. It was 3.5 million barrels a day that's been added, but all in all, there is a massive underinvestment in the commodity space. It has been for the last 10, 15, 20 years, and they always say, and the quote probably better than I do, the best remedy for high prices in commodities is high prices, because then people will invest less, and the best remedy for low prices is low prices, because then you will start to add production, or the other way around, of course. And when it's too high, you will invest, and if it's too low, you will not invest. But the point is, because of the permitting, because of the lack of investment, because of companies are extremely prudent, for one, the big guys this time around, because they want to conserve capital, they want to buy back their own shares, they want to increase the dividends, the cash flows. So they've not invested, let's in a space like they used to, and then that means that the cycle, I think, for the producers, for the mining sector has been delayed to a certain extent, because typically when prices go up, like we have seen in copper, okay, now they've consolidated a bit, and but also in gold and silver. Typically, you see the mining companies do very well, but at this moment, there is no speculation whatsoever in gold and silver, also not in gold, because investors are just not on board with gold. It's just the central banks who have bought gold to diversify away from the dollar, and investors have been even selling gold or not buying a lot. And of course, central banks do not buy silver. Maybe Russia is going to in the future, but at the moment they're not buying silver. And central banks do not buy mining stocks either, so they have lagged badly. But I think there is, like you say, there is a lot of value in a lot of them. And I think what is going to happen over the next months and years is that the big players will get re-rated because they're cheap, they generate a lot of cash flows, they can buy back shares, and then eventually the M&A cycle will start, and the big players will start to buy the mid-tier players, and then the mid-tier players will start to buy some of the juniors because everybody has to fill up their pipeline, and with some delay, I still see massive opportunities in the mining sector, gold, silver, copper, you name it. It's going to come, but people are so negative on the sector, I think, because it has underperformed for such a long time. Well, this takes a while, but I think we already had some nice runs this year in the sector. They've not kept up with gold or the metal prices, but still they went up nicely. But in my mind, gold could go way higher. Silver is the cheapest commodity on the planet, I believe, and eventually miners will catch up as well with some leverage, because typically they should go up more. They have a massive leverage on the price of the metal. We've not seen that yet, but I think that's going to come. So I think there is a massive opportunity there.
Do you think because we might, like when this super cycle does come into the commodities market and we see whether that's mid-tier, juniors, whatever, they all start taking their run, do you think we're going to see a transition from investors in the tech space over into the energy space? And again, because of geopolitical issues, that energy sovereignty on almost the entire world is going to become the forefront of creating that super cycle?
Well, I think a number of things. Is a very good question. Thank you for that. And it's not a very easy answer to that, but I think that's the way we play it. Of course, we're an asset manager, so we're also in the tech space. So we invest in them for our clients. But a way to invest in the AI space, for example, or in the AI boom, is also through the energy sector, because you will need a lot of energy. If you run a ChatGPT search, it will cost you 29 times as much energy than a Google search. If you want a data center of decent size, it's the same use of electricity of about 2 million people. So it's huge. So there will be a huge demand for all kinds of energy, alternative energy, but also oil, gas, nuclear, without a glimmer of a doubt. I think that the nuclear renaissance is in full swing, and there you have seen some of the miners or the juniors doing well. So they've kept up a little bit with the uranium price at least. So that's a way to invest there. It's also clear, and I agree with you, that the energy space, for example, in the S&P is underowned. At the highs, it can be 12, 13, 14% of the index. Today it's 4% because all the market cap is in technology. So when things normalize a bit, well, there is plenty of room, I think, for example, energy stocks, and also the big guys, the majors and so on, the oil services and the Schlumbergers and the Occidental Petroleums and the Exxons of this world to re-rate. And then you will see the same thing. Maybe they're going to on a buying spree also, and start to buy mid-tier players and then also smaller players in a way. So there is absolutely room to re-rate, and it's not for nothing that Warren Buffett, who knows most of the time what he's doing, is also investing, for example, in Occidental Petroleum. So I think that's not a bad move at all. Of course, for technology people to buy resources, that's maybe not the same type of buyers. I don't know what they're going to do. They're going to transition in something, and they could buy a Newmont Mining or a Cameco or the big guys, but I don't think that they will necessarily go into the junior mining space, because that's in a way a more speculative part of the market. There we would maybe have more Bitcoin people who transition to the junior mining sector. So I think initially it will be the big guys who buy the mid-tiers who start to buy the juniors, and then when things are 50 to 100% higher, which could go fairly fast when things get moving, then of course people will start to pay attention. And then I think a lot of these investors, then I think it's possible that people who are now in tech will start to buy trackers. They will not necessarily buy individual names, but they will start to buy gold mining trackers or gold and whatever. Gold, by the way, is also still very much on the road. If you see a classical portfolio at the moment, and there are always exceptions, you always have gold bugs and so on, with 10 or 15 or 20% of their assets in gold. But on average, I think worldwide, I saw some figures about it, and I could be wrong with a couple of basis points. But I think in an average portfolio worldwide, there is about 0.5 to 1% gold or gold related or commodity related assets. So like I said, there is a wide room to improve and then to take that level higher. And like I said, at the height of the energy boom, energy was 15% of the S&P. Today it's 4%. So I think there is re-rating potential. So yeah, I'm very excited about the commodity space, as you can hear, and I'm also very excited about the mining sector, because you're absolutely right. At the end of the day, if you want to do this transition, you need a lot of these materials. And there is a book, How the World Ran Out of Everything, or The Wars Below. So there are some books being written about commodities, but not a lot. So there is not a lot of interest, but that can change fairly quickly.
Well, I think you're making a good case for having interest back in commodities. I wanted to, as you touched on, the AI is basically an energy play as well. Bitcoin really, again, is another energy play. The amount of energy it takes to mine those is astonishing. So for investors, because I feel like a lot of, again, the younger millennial investors, they ride that wave and the trend of Bitcoin because it doesn't feel the same as, traditional gold investments or junior mining companies. What do you think is going to happen with Bitcoin over maybe the next year? And do you think would you call it an asset, or is that just another fad that we're going to watch?
As a bank, we do not invest in it, and we do not have an official advice on it. So it is a hard one. I'm not a very technical guy either, so I must admit that I do not really understand all the technology behind it, and what you don't know, it scares me a bit. Now, in the book, as you have seen, I have an open mind to Bitcoin. I'm a fan of blockchain technology, and I'm also a big fan of everything that's smart contracts, because in the Netherlands and in Belgium, where I live, we have a famous painter, Vincent van Gogh, who painted the sunflowers. You maybe know it. It's paintings that go for 100 of millions or billions even at the moment. But the man died extremely poor because nobody wanted his art. And he was supported a little bit by his brother, who gave him paint and who gave him food and a bit of shelter and so on. And then to just give him something, he gave some paintings, which were at that moment worth absolutely nothing. But now, if you would have only a very small one, you would not care about Bitcoin or gold, because you would be extremely rich with just one painting. But if you could go to the man when he was very poor and he was suffering, and unfortunately he also never knew how successful he became after his death, that happens very often with artists and writers and so on. But if you could have said, look, Vincent, I absolutely believe in you. Here is a nice house, here is paint, here is food, shelter, whatever you want, but you give me 10 or 15% of your revenue streams. Then the guy who would have done that would be extremely rich and done a very nice thing. So smart contracts will allow us, I think, to invest in stuff that you cannot invest in. And when you open your brokerage account on your PC or on your smartphone, well, you have a list of the stocks that you own. Well, in the future, we'll have a list of, I have 10% of that bakery, I have 3% of that winery, I have 7% of a painting. I have 5% of the revenue streams of a certain writer or artist. So that will open up a lot of things. So I believe that a lot of the technology behind the entire Bitcoin story is very interesting. Now, Bitcoin itself, is it an asset? Is it, in my mind, it's not really a currency, because when you're a currency, you should have certain characteristics. You should be a unit of account, you would be a medium of transaction, and you should be a store of value. No, a unit of account, it's more or less okay because you can count in Bitcoin. Medium of exchange, possibly, but you're no longer buying a pizza with your Bitcoin. So are you then a store of value? Well, a store of value, you would like to be more or less stable. You do not want it to go from 60,000 to 10,000, then to 100,000. As long as it's going in the right direction, is all okay. But for a store of value, you want something that's stable. And I often play the trick with students when I teach or do lecture at the university from time to time, guest lecture. And I always take the Bitcoin chart and I take the name Bitcoin of it. But of course, I cannot fool them because they know the Bitcoin chart by heart. So they immediately say, that's Bitcoin. But then if you ask some more questions about it, you can say in a way, look, if I were to take it off and you would look at that chart, what would you think it is? And nobody would say it's a currency. So everybody would say it's a highly speculative technology stock, for example. And I think there is also a very big correlation, by the way, between the Nasdaq and the Bitcoin. So to cut a long story short, I do not really know the answer. I have an open mind to it. Now, what's maybe interesting, the parallel that's often drawn between gold and Bitcoin, because they're both extremely difficult to value. They both take their value because they're scarce. They both have miners. You can mine them. And also in the Bitcoin space, the miners are badly lagging the Bitcoin itself, just like the miners in the gold space. So there are a number of very interesting parallels to be drawn there. So yeah, I look at it with a lot of interest. My wife tells me each and every day, you look at markets the entire day, why don't we have Bitcoin? And I'm afraid that I do not really have the answer, but I just have an open mind to it.
For your 10 to invest in for the energy transition, you talk about that it's the most important thing to look at right now. And you also talk about the energy return on investment. Can you just break that down a little bit for investors?
That's a fantastic story. And like I said, if you steal from one person, it's plagiarism and you could go to jail. When you steal from a lot, it's research. And we borrowed the concept of Eroy, and you maybe know the guy is very good at everything that's commodities, so maybe you should have him on your show. It's Adam Rosenzweig. So he came with the idea of an Eroy. And what's an Eroy? Well, we all know ROI, return on investment. You have $100 or euros or whatever. You make 7, so 7 on 100 is 7%. That's a return on investment. An Eroy is the same, but you do it with energy. And you should picture a tribe back in the Stone Age, and they all make spears, and they go to hunt the mammoth, and they kill the mammoth, and then they cut the mammoth into pieces. They bring him back to the village. They cook the mammoth, they eat the mammoth, digest the mammoth, and then you get some energy in return. So if you compare all the energy that it costs you to hunt the mammoth, eat it, digest it, compared to what you have in chemical energy from eating the mammoth, well, that's your Eroy. And that's 500, and that's well documented. So you would say, well, that's a fantastic amount, because if I give you 500% times 5 on an investment, I guess most people would be very happy. But an Eroy of 5 or 500 is not so big, because that's the world we had until the Industrial Revolution. From the early days until the Industrial Revolution, the Eroy was about 5. And an Eroy of 5, that's a world, okay, sometimes you have some philosophers, sometimes you have some progress, but that's a world that's more or less stable, because you do not have a lot of excess return to invest in stuff. And you can have pharaohs or kings or emperors from time to time, but if the average is 5, and some guy want to live at 5 million, Well, that means you can only do that when you have an army of slaves. You can have one city of about 1 million people, Athens, Rome, some other cities, but not all at the same time. And a city like that can only exist if they pillage the rest of the world. And typically the rest of the world is not always very happy with that for a long time. So then empires fall. But all of that changed when you had the Industrial Revolution, because all of a sudden you started to burn coal. And coal has an EROI of 15. So that's, of course, very polluting. It created inequality. You had child labor. So there were some very nasty things. But your EROI went from 5 to 15. So all of a sudden you could start to build railways and harbors, and you had progress. Then, a couple of hundred years later, you had oil. That's an EROI of 25. Uranium, nuclear, has an EROI of about 50. Now, that's documented, that's in research. I've not used a figure or taken a figure for solar and wind, because then the big discussion starts with what are you going to count, all the concrete, are you going to count the recycling, and so on. So the discussion would go on and on, because it would be the same between a glass bottle and a plastic bottle. Both sides have massive bodies of research to prove that their thing is better than the other one. So I did not want to go into that discussion, but suppose, and I think that's the case, that the EROI of solar and wind is lower than it is of petroleum and certainly of uranium. Well, that would be the first time in recorded history that you do an energy transition with a lower EROI. And if you have a lower EROI, well, that means that the cake that you can divide up to your people gets smaller. And in a world where you already have a lot of conflict, that's extremely difficult. So that means that if you want to do this transition, you should get the EROI of solar and wind and so on quickly higher and higher. And you need a smart grid, and you need new batteries and so on. So I'm very hopeful, because we talk in the book, a quote that I often write when I sign books for people. I always said you need less prophets and you need more wizards. You don't need people who say we're going to die, we're going to drown. No, you need wizards that can create the new batteries and the grid of the future and so on. So I'm not pessimistic on this, but you should do it in a pragmatic way. You should, if you want this transition, well, you need the materials, you need the commodities, and you can say, we will recycle and so on, and let's hope in the future that we can do that in a better and a more environmental friendly way. But at this moment, bottom line is, for copper, for example, there is a wall of demand coming in our direction. That's clear. You would need at least 200 new mines, and they're nowhere to be seen. And even if you were to start them today, it will take you 10 to 15 years at least before you take the first ounce of copper out of the ground. So this is, if you put demand and supply together, I do not see how copper cannot go massively higher. And in the book we have could double, and that's maybe provocative, but look at oil. During the oil crisis, oil was at a certain moment at $5 per barrel, then it went to 60, then it went to 100, even went to 200. So a commodity, we've seen that with antimonium and then some others, if it goes up, it's not for 10 or 15%. Look at cacao, look at cocoa, look at coffee. If commodities move, it's big. It's not for 5 or 10 or 15%, it's double, triple, or more. And I think that's what's going to happen in the commodity space. And soft commodities are already at their highs, but that's more a climate change thing. With the metals, I'm extremely excited about the space, and maybe the most on copper, because if you want to take electricity from point A to point B, you still need copper today. Lithium and others are a little bit more complex, because nobody knows how the batteries of the future are going to look. So if you were to replace lithium by sodium, for example, that would change the game. Now, if you look at the newest batteries, if you look at the solid state batteries, they have about 200 grams of silver in them as well. So if I were to pick one commodity I particularly like, I would immediately say gold and then copper, but I would even more like silver, because I think there are a lot of very interesting things going on there as well.
Well, silver is personally one of my favorites, and I mean, it's so important in the whole solar industry. And I wanted to touch on that as well, because that's one of the other trends in your book is hyper innovation. And you've briefly just mentioned some that we need wizards. Do you feel that's kind of the next cycle as well? Once we go through this commodities super cycle, is this innovation will be following or in parallel, or?
Well, I think you need, for the innovation, you need, of course, a lot of computer power. You need data, but you also need material. You need data centers. You need wiring. And you can not run anything without the wiring behind it. And like you say, silver is very interesting there, because silver has not followed gold. Typically, it follows gold. The gold silver ratio is historically extremely high. So they would say, and gold is not too far from an all-time high. Well, silver is 31 or something, $31 an ounce. It was at 50 during the 2000s somewhere, and it was even 50 during the 80s when the Hunt brothers cornered the silver market. So you have a double top at 50, and you're still way below that. So this makes, I think, silver one of the cheapest commodities that I've ever seen. If you were to correct for inflation, well, the first top would be 160 or something. The second top would be 70 or 80. So you have way to go there. But like I said, central banks at the moment are not buying it, just like they're not buying mining stocks. So they're not benefiting, and the central banks have been driving the gold price. But I think you're absolutely right. If you look at silver, it's half of it is precious metal, but half of it is also, for the demand, is also an industrial metal, and then you get into the solar panels and so on. So a lot of the technology of the future, solid state batteries, you need a lot of silver, and silver has been in deficit for 3 years now, or 2 years now, and it will be in deficit for next year as well. So you're still using some of the inventory. There is also quite a bit, like the coin, you know that better than I do when you talk about these things, a lot of paper silver, and they sell it, but there is no material behind it. So I think at a certain moment in time, there is big opportunity for a squeeze in silver at a certain moment in time, and some of the vested interest will try to prevent that. But I think once silver moves, I think that also the mines will move, and especially the silver mines, because if silver starts to run in earnest, it's because the deficit on the industrial side becomes so big. That's one possibility, or that investors discover silver and start to buy it. But if they start to buy it, they will also buy gold, and they will also start mines. So if the silver price goes to, let's say, to start with, to 50, well, I also think that all the miners will move, because it will also be proof between brackets that there is interest in the space. But I'm extremely excited about the silver price. So yeah, it's pausing now after a nice run, but I think there is, if you look at this at a 3 to 5 year horizon, I think there is a massive opportunity here.
So we've talked about commodities and the energy transition and all the different trends that are coming in. And obviously, like I mentioned, the 60-40 traditional portfolio since 2022 really has not performed the way it used to. What do you think we're going to transition to as the new norm for a portfolio? Do you think it's becoming like a 30% on the asset side and commodities, or what do you think is going to be a good balance that we're going to see in this inflation period?
Well, that depends, because we have always different types of portfolios: defensive, middle of the road, more dynamic. But it's true. 60-40 portfolio performed very well since 82 onwards. The 60-40 portfolio does well in an environment where there's low inflation. Because what happens then is when you have a recession, the stock market goes down, you have a crash, money flees into the fixed income goes up, interest rates go down, and you compensate to a certain extent what you lose on the equities by on the bond side, on the fixed income side. So you have a negative correlation between the two. That applies less or does not apply anymore at all in a world where inflation is high, because then inflation will go up, it will drive up interest rates, and that will drive down stock markets. So bonds and equities go down together. And once I think that markets realize that, you will indeed start to go to other assets, and then you will come to precious metals. But you will also have things, and that's very interesting for the commodity space as well. You will have to have more interest in trend following, for example. And then you have the CTAs who very often have commodities as underlying, and they play them to the upside and also to the downside because they just follow the trend. But basically, CTAs are a very, very small portion of the market, just because over the last 30, 40 years, the 60-40 portfolio worked very well. And even if you would have looked at it this year, okay, when you're in European stocks, when you're in Chinese stocks, when you're in emerging market stocks, you would not have done well. And then I read an article a couple of days ago that the average portfolio in the US of an average investor is up about 4 to 5%. Well, the S&P is up 25% because there you have all these Nvidias and Magnificent Seven and so on. So, but if you were in the S&P 500, well, alternatives this year once again would have had a difficult year to catch up. But it will not be each and every year that the S&P 500 goes up 25%. So, and if the correlation goes down, I think that people will start to look for alternatives. And commodity space, gold and silver, are certainly usual suspects for that. But I think also structured products, some hedge funds, which are out of favor as well. And then the CTAs, the trend followers. But if you have more money flowing to the trend following space, and a lot of them are in a lot of different markets, but including commodities, that in itself will create more interest, more volume, more liquidity in commodity markets, and that could also be one of the reasons behind the renaissance of the entire sector. So, but depends from client to client, profile to profile, risk appetite, how much you exactly would put into the alternative space. But I think that's where the market should and probably will go.
I wanted to quickly touch on, obviously, the geopolitical tensions everywhere. I feel like this entire world is polarized. You don't have to go, outside your neighborhood to see polarization. Do you think Trump is going to be positive for the commodities space? And do you feel a lot of these changes are going to, again, help with that super cycle?
That's a very difficult one. Now, let me first talk a bit about the geopolitics, and then I will eventually and then fatally getting to Donald Trump, because we cannot have a conversation without him these days. So first of all, and that's once again a book that we borrowed, and it's a fantastic book. It's The Fourth Turning. It's here by Neil Howe. It's an update of a book that was written by Neil Howe and Strauss 30 years ago. This is an update. And what's the fourth turning? Well, the fourth turning is exactly what you describe, a period of high geopolitical instability, uncertainty, unfortunately wars between countries. And we see that in Ukraine, we see that in the Middle East. I hope we will not see it in the East with Taiwan and China and so on. But that's what you would expect to see in a fourth turning. And it's also a period of massive uncertainty and political turmoil within countries. And there the energy transition comes in. When you're in a fourth turning and you do not do the energy transition in a pragmatic way, you run the risk that extremist parties are going to win even more, because that's also a world where extremist parties from the left and the right, they win. The center gets smaller and smaller, and the center cannot take the measures that are necessary. And you talked about a crystal ball. Unfortunately, I do not have one. And I know this may be a sensitive topic, but I still have to drive through my home city and a lot of other cities in the country to collect all the bottles that I've won by saying Donald Trump is going to win, and he is also going to take the House and the Senate. And that was not the general view, because that only held 10% probability. But that also plays down, and that's the reason why I said that, also plays down to that fourth turning thing, because in a fourth turning, that's also one of the characteristics, sitting presidents and governments lose, whether they're left, whether they're right, whether they're up, whether they're down. People are so unhappy that they vote out whoever is in power. And we've seen that time and time again in Europe as well, in France, in Belgium. I live in the north of Belgium, but the south of Belgium is French speaking. That's typically left wing. Well, guess what? The right wing won. We saw that in Holland. We saw that in the United Kingdom. Exactly the opposite. There the right corporate, the Tories, the Conservatives were into power. They were voted out by Labour, which are basically the socialists. So it does not matter too much who's in power, the sitting president, sitting government, they lose. So therefore, I was not that much surprised by the Trump victory, because that's what happens in a fourth term without making any political preferences or what have you. Now, at first sight, you would think that the Trump victory is clearly inflationary, because he's going to put up tariffs, he's going to do changes in the labor market, he's going to stimulate the economy, he's maybe going to take away some of the independence of the Federal Reserve. So these things are all in a way inflationary. Now, at the moment, commodity space and also gold is a little bit under pressure, because interest rates go up, because the deficit is maybe going to go up, and the total debt as well. And the dollar is going up, which is typically not good news for commodity prices. Longer term, I still think that when the world is inflationary and more inflationary, and geopolitical worries will get worse before they get better, there is a nice room for commodities and also gold and silver to run. So I think it's going to go up. On the mining side, especially in the United States and in Canada, I think, and maybe Mexico to a certain extent, but maybe a little bit less. But it depends on the relationship between the United States and Mexico. But drill, baby, drill. That means maybe that he will give more permits to mining operations. He has understood, I think, and especially the people around him, that if he wants to be independent from China for critical metals, rare earths, and what have you, and the United States has a lot of reserves. Canada has even more reserves. I think that there will be more lenience towards granting permits and allowing mining companies to operate. So I think commodities will be in their super cycle. I think Donald Trump will reinforce that, but it will not be a smooth ride. It will be extremely volatile. But on the mining sector, I would say it would help, because it's less alternative energy, it's more classical energy. Like I said, drill, baby, drill. That in a way should be good for the mining sector. So making abstraction of all the other issues that one could have with Donald Trump and his policies, for the mining sector and for commodities, I think it's very good news.
Well, drill, baby, drill feels like a great answer. I'm sure a lot of the North American side will love hearing that. You have given a wealth of information today. I want to come to a close with this. Obviously, I feel like the best thing any investor can do is buy your book. So let us know where you can buy your book.
It's on Amazon, it's on Barnes and Noble, but I think that Amazon in Canada, Amazon in the United States is the best place. And yeah, we've been selling quite a bit of books in Canada as well, because through Amazon, because when we talk about commodities, well, that's I always feel a little bit humbled, because I talk about commodities, and then okay, in Belgium, the country where I live, we don't have petroleum, we don't have gold or nothing. We used to have some coal, but that's out of fashion. So I'm a guy in the desert who is talking about lakes and about water and so on. But I've been a commodity investor, and I've been looking at the space for a very long time. And virtually in a virtual way, you can participate in Vancouver resource presentations and stuff like that. So I know a lot of people in the sector, but yeah, it always feels a little bit strange that a guy from Belgium comes to talk about commodities in a country like Canada. But okay, maybe your listeners will forgive me for that.
It's been fantastic, and I so appreciate it. For closing, I know you have your 10 to remember and 10 to invest. Do you want to maybe do 3 to remember and 3 to invest from the show today of what you want to leave investors with?
I think we will, in a world of higher inflation, higher interest rates, and higher commodity prices. So we should invest in them. As a company, I think you should be hedging a lot of these things, because in a world where interest rates came down all the time, where commodities were low for a very long time, and where inflation was not an issue, it was very easy to run a business. I think this will be more complicated. And like I said, everybody hires people for AI, and I can understand that. But that's also inflationary, because the commodity space, and you're obviously still a very young or reasonably young lady. But in the commodity space, you have a lot of old people, because they closed down the schools. Young people do not want to work in the commodity space at the moment. I have good friends that are already 70 or 75 or 80 years old, and they call them and they say, we're 75 years old, but could you please come and work and open a mine for us, because we don't find the people. So that's something that will be very interesting as well. So I think for young people, there are opportunities there. They do not see it yet, but they will. And then, of course, as an investor, well, this is a world where you need to own real assets. Okay, everybody is worried about real estate, and I can understand this, because there's probably here and there some bubbles in real estate worldwide. But in a way, cash is absolutely not an option in this world when you have inflation of 4 or 5%. So you should be in real assets. And for some people, that will be real estate. For other people, that will be equity. For still other people, it will be commodities, gold and silver. And maybe one to remember, if I can pick one commodity, but I already said it, I would go with your favorite, and then that's silver.
Well, that does it for today's Exploring Mining podcast. If you'd like to be a guest or sponsor for this podcast, please contact InvestorIdeas.com. InvestorIdeas.com reminds all listeners to read our disclaimers and disclosures on the InvestorIdeas.com website. All investment involves risk, and this podcast is not meant to be an endorsement to buy or sell securities or products. To hear more podcasts, you can go to InvestorIdeas.com/audio. And a reminder, you can also hear our podcasts on iTunes, Spotify, Google Play Music, iHeart.com, TuneIn, Stitcher, Spreaker, and SoundCloud.